Hello everyone and welcome. My name is Larry Kushner and I'm with Cornerstone Wealth Management Group. In this presentation on college planning, we'll look at how much college costs today, projected costs for the future, and the building blocks that go into funding a college education. We'll look at different tax-advantaged ways to save for college, and we'll also examine the role of financial aid. At the end of the presentation, we will let you know how to contact us with any questions you may have. Cornerstone Wealth Management Group is an independent personal wealth management firm that focuses on comprehensive strategic financial planning for individuals and businesses. At Cornerstone, we believe that a plan is a powerful tool and that your long-term financial objectives hinge on having the right blueprint. We provide independent advice based on a holistic approach, analysis, and a clear understanding of our clients' financial, business, and personal objectives. We all know the benefits of a college education: the ability to compete in today's competitive job market, increased earning power, and expanded horizons. But if you're like most parents, there are a lot of demands competing for your hard-earned dollars. The costs associated with a new baby or growing children, monthly mortgage or rent payments, monthly car payments, contributions to your retirement plans, your own student loans, and maybe even a nice vacation now and then. Add in the cost of bills and unforeseen emergencies, and it's hard to imagine how you might fit in savings for college too. And yet it's imperative that you start your child's college fund as soon as you can. Why do you need to start saving for college now? The answer is the high cost of a college education. Unfortunately, college costs continue to go up, and there's no end in sight. According to the College Board, for the academic year 2012-2013, the average cost for 1 year at a four-year public college is $22,261. And at a four-year private college, the average one-year cost is $43,289. These figures include tuition, fees, room and board, and a sum for transportation and personal expenses. Multiply each figure by the number of years and your child will be in college, and you can see how expensive college really is. And we haven't even factored in college inflation yet. And in the Northeast, it's even more expensive. Let's take a look at some popular colleges locally. The University of Connecticut is $27,654, and this is for in-state students. Yale University is $56,300. Boston University, as you can see, is $64,477. NYU, $59,337. Northeastern University is $55,296. And Quinnipiac University is $55,780. These cost figures include tuition, fees, room and board, books, transportation, and personal expenses, and they're before any scholarships or any financial aid. College inflation refers to the percentage by which college costs increase each year. Over the past decade, college inflation has increased on average at a rate more than double that of general inflation. This chart shows how much college might cost in the future, starting with current cost figures and a somewhat conservative college inflation rate of 5%. As you can see, in about 10 years for the academic year 2022-2023, the cost of 1 year at a public college could be over $36,000, while the cost of 1 year at a private college could surpass $70,000. It's probably a given that college costs will continue to rise each year. Annual increases in the range of 4 to 7% would certainly be in keeping with historic trends. But keep in mind that the actual percentage increase in any given year could be higher or lower, and the rate could vary from public to private college. What does this mean for you? Just that on top of the high cost of college now, college costs will keep increasing, which will add to the amount you'll ultimately need to save. Now, before you throw up your hands in despair at these daunting numbers, I have some good news. And the good news is that the money you save for college will probably play only one part, albeit a big part, in the successful financing of your child's college education. Think of your college savings as just one block in a block tower. In addition to your college savings, some of your child's college costs may also be covered by financial aid, which may include student loans, grants, scholarships, and work study from the federal government and your child's college. Your income during the years your child is in college, plus any part-time job earnings from your child. Other borrowing options during the college years, such as a home equity loan or Parents Plus loan. Creative cost-cutting measures, for example, having your child attend a community college for 2 years before transferring to a 4-year college, or encouraging your child to choose an accelerated degree program where he or she can graduate in 3 years instead of 4, and hopefully generous gifts from grandparents or others. So even though college costs are high, think of your savings as a down payment of sorts on the full sticker price, similar to a down payment on a home. A good rule of thumb is to aim to save at least 50% of your child's projected college costs. Now, before we go on, I want to talk a bit about financial aid because many parents who are saving for college assume that financial aid will cover most college expenses. Financial aid is money given to students primarily by the federal government and colleges to help pay for college or graduate school. This money can take the form of a loan, grant, scholarship, or work-study job. Loans and work-study must be repaid either through financial obligations, in the case of loans, or service to the college in the case of work-study. By contrast, grants and scholarships don't need to be repaid. How is your child's financial need determined? Both the federal government and colleges examine your income, assets, and family information that you've listed on your aid application. Your income is the most important factor in determining your child's eligibility for financial aid. All of your information is run through a special formula. The federal government's formula is called the federal methodology. Colleges typically use what's called the institutional methodology. The result is a figure called your expected family contribution, or EFC. The EFC is the minimum amount of money your family must contribute towards college costs as a prerequisite to receiving aid, and it remains the same no matter which school your child attends. The difference between your EFC and the cost of your child's college is your child's financial need. There are computer software programs available that allow you to input your current income, assets, and family information to get an idea of what your EFC will be, and a financial professional should be able to do this for you. There's an important point I'd like to make here. When calculating your EFC, the federal government weighs parents' assets differently than child's assets. Parents' assets are assessed at a rate of 5.65%, while child assets are assessed at a rate of 20%. This means that $10,000 in your bank account would translate into an expected contribution of $565 from you, which is 5.65% of $10,000. But that same $10,000 in your child's bank account would equal a $2,000 contribution from your child. I'm bringing this up now because a little later in the presentation we'll see that some college saving options are classified as parents' assets while others are classified as child assets. This means that the college savings vehicle you choose will affect the amount of your expected family contribution and thus the amount of your child's financial need. So you may be wondering about grandparents' assets and how do they get treated, and does it make sense to put all the college savings in a grandparent's name? While it is true that assets held in a grandparent's name don't get calculated into the federal methodology for the calculation of the EFC, it may not be a good idea to put all the assets in a grandparent's name. The reason for this is in that the year after the assets held in a grandparent's name are used for college, they would count as 100% income for the child. Planning and using a balanced approach where the grandparent's assets are used in the senior year of college would prevent this from happening. This is why planning and using a holistic approach and working with a financial professional is important. Do all assets count in the calculation for financial aid? Well, it depends. It depends on the individual college and whether they are using the federal or institutional methodology. Retirement assets, cash value life insurance, and annuities are not used in the federal EFC calculation, but may be used in the institutional methodology. And assets that are held in a small business are generally not counted in the federal methodology, subject to certain guidelines. How much should you rely on financial aid to cover your child's college expenses? Unfortunately, not much. Although financial aid can certainly help cover expenses, student loans make up the largest percentage of the typical aid package, not grants and scholarships. According to an October 2012 report by the Project on Student Debt, entitled Student Debt and the Class of 2011, approximately two-thirds of college students who graduated in 2011 had student loan debt, and the average debt was about $27,000. As a rule of thumb, what percentage of college expenses can you expect financial aid to cover? Well, assuming your child qualifies for aid, plan on loans covering anywhere from 0 to 50%, grants and scholarships covering anywhere from 0 to 15%, and the amount covered by work-study jobs varying. Remember, parents and students who rely mainly on loans to finance college can end up with a considerable debt burden. The bottom line is to focus on your own savings. And with that in mind, let's turn now to establishing a savings goal. This table shows how your college fund can grow over a period of years if you invest a certain amount of money each month. The figures assume an average after-tax investment return of 6%. For example, if you save $100 a month for 15 years, you'll have almost $30,000 in your child's college fund. The sooner you start saving, the more time your money will have to grow. Now, you may be thinking back to the first slide where we looked at all the demands on your hard-earned dollars, and you may be thinking, I can't possibly save $200 or $300 a month. A good plan is to start saving with whatever amount you can afford and to add to it over the years as you receive raises, bonuses, tax refunds, and unexpected windfalls. As your child grows older, he or she can also contribute to the fund by earmarking a portion of birthday or graduation money, as well as earnings from a part-time job. The important thing is to start saving, even if it's not as much as you'd like. The next topic we're going to address is where to put your money. You have several college saving options to choose from. These options include 529 plans, Coverdell education savings accounts, U.S. savings bonds, custodial accounts, mutual funds, and individual stocks. Not included in this list are certificates of deposit, money market accounts, and traditional bank savings accounts. While these vehicles may be a good place to park your short-term savings during the college years, they probably shouldn't be the core of your long-term saving strategy because their rate of return won't help you keep up with college inflation. We're going to focus on the options that offer special federal tax advantages if they're used to save for college. These are 529 plans, Coverdell education savings accounts, and to a lesser extent, U.S. saving bonds, and custodial accounts. Why the focus on tax advantage strategies? To get ahead in the college savings game, you should use tax advantage strategies whenever possible. This chart shows the impact federal income tax can have on your college's savings, assuming an initial investment of $10,000, a 7% annual return, and a tax bracket of 28%. The orange line represents a taxable investment, for example, a mutual fund held in your name. The blue line is an investment that's completely tax exempt at the federal level, for example, a 529 plan. Over 18 years, that $10,000 in your 529 plan would have grown to $33,799. But the same $10,000 in your mutual fund would have grown to only $24,232, a difference of $9,567. So as you can see, taxes can have quite a significant effect in terms of how much you can save in your college fund. Now let's talk about 529 plans, one of the most popular tax-advantaged college savings options. What is a 529 plan? A 529 plan, or qualified tuition program, is a college savings vehicle that offers federal and sometimes state tax advantages. 529 plans are sponsored by states and less commonly colleges, but they must follow federal law. Specifically, they must abide by Section 529 of the Internal Revenue Code, hence the name 529 plan. 529 plans were first authorized by college in 1996, and since that time they have revolutionized the way parents save for college, much like 401k plans revolutionized the world of retirement savings. There are actually two types of 529 plans, and they are very different college savings vehicles. The first type of 529 plan is called a college savings plan. The second type of 529 plan is called a prepaid tuition plan. With either type of plan, you are the account owner and control the account, your child is the beneficiary, and your contributions grow tax deferred, which means you don't pay income tax on your earnings each year. You don't need to be a parent to open a 529 plan account. A grandparent, relative, or friend may open an account and contribute money on behalf of your child. So how do these plans work? College saving plans are offered by states. Prepaid tuition plans are offered either by states on behalf of public colleges or by private colleges. College savings plans are the more popular type of 529 plan. Nearly all states offer at least one college savings plan. By contrast, fewer states offer prepaid tuition plans, and currently there is just one college-sponsored prepaid tuition plan in existence. Typically, you can join any state's college saving plan no matter which state you live in. However, you're usually limited to your own state's prepaid tuition plan, though the one active college-sponsored prepaid plan is open to residents of any state. With a college savings plan, you contribute money to one or more of the pre-established investment portfolios that you choose when you open the account. Most plan portfolios typically range from conservative to aggressive in their amount of risk, similar to 401k plan offerings. Returns aren't guaranteed. With a prepaid tuition plan, your contributions are pooled with those of others and invest solely by the plan. Typically, you are guaranteed a certain rate of return, which means that the plan agrees to cover a certain amount of tuition costs for your child in the future based on how much you contribute today. In effect, you are prepaying your child's tuition. Let's look at the advantages of 529 plans, which apply to both college saving plans and prepaid tuition plans. First, anyone can open a 529 plan account regardless of income level. Second, 529 plans have high maximum contribution limits, especially college savings plans, which typically let you contribute $300,000 or more. Third, you maintain control of the asset in the account. Fourth, 529 plans offer professional money management. With a college savings plan, you pick your investment portfolio, and it's the plan's job to manage the specific investments within these portfolios on a daily basis. With a prepaid tuition plan, you just contribute money and the plan does the rest. Finally, perhaps the greatest advantage of 529 plans is that any money you earn in your account is completely tax-free at the federal level when it's withdrawn if it's used to pay qualified education expenses. And it may be tax-free at the state level too, depending on the state you live in. Plus, many states offer other tax benefits to their residents too, like the ability to deduct 529 plan contributions. Just keep in mind that some states may make their tax benefits conditional on residents joining an in-state 529 plan. 529 plans also offer an excellent estate planning advantage in the form of accelerated gifting. This can be a favorable way for grandparents to contribute to their grandchildren's education. Specifically, you can make a lump sum gift to a 529 plan of up to $70,000 or $140,000 for married couples, and you can avoid gift tax provided you treat the gift as having been made in equal installments over a 5-year period and you don't make any other gifts to that beneficiary during the 5-year period. And assuming you're the owner of the 529 plan account, you'll retain control of the account assets. However, if you should die within the 5-year period, a portion of the gifted amount will be included in your estate for estate tax purposes. Now let's look at some of the disadvantages of 529 plans. For college savings plans, investment returns may not keep pace with college inflation. In fact, you could lose money. Remember, there are no guarantees. Second, you give up some investment control when you join a college savings plan because you're limited to the plan's pre-established investment portfolios. And some plans may have inflexible rules about how often you can change your investment choices. For prepaid tuition plans, disadvantages include the fact that your child is limited to the colleges that participate in the plan. For state-sponsored plans, your child would be limited to the public colleges in that state. By contrast, with college savings plans, money in the account can be used at any college in the country or abroad that's accredited by the U.S. Department of Education. Also, there's the possibility that prepaid plans may be unable to deliver on guaranteed returns due to state financial troubles, soaring college costs, and mediocre investment returns. Also, for both types of plans, if you withdraw money for a non-educational expense, you'll pay income tax on the earnings portion of the withdrawal at your tax rate, and the earnings will also be hit with a 10% federal penalty. Plus, there are typical fees and expenses associated with each type of plan. College savings plans usually charge a flat annual maintenance fee, investment fees, and an ongoing management fee that's typically equal to a percentage of your account's value. Prepaid tuition plans usually charge a flat enrollment fee and various administrative fees. Even with all these potential disadvantages, 529 plans are still an excellent way to save for college. Now let's look at another tax advantage college savings option. You may have heard of Coverdell Education Savings Accounts. A Coverdell Education Savings Account is a tax-advantaged education savings vehicle that lets you contribute up to $2,000 per year for your child's elementary, secondary, and college expenses. You have complete control over the investment you hold in your Coverdell account, and like a 529 plan, your money grows tax-deferred, and any earnings in your Coverdell account that are used to pay for qualified education expenses are completely tax-free at the federal level and typically at the state level too. Unfortunately, though, only people with incomes below a certain level can open a Coverdell account, which we'll discuss more in a moment. Finally, the earnings portion of any withdrawals that aren't used for qualified educational expenses will be subject to an income tax at the beneficiary's rate and hit with a 10% federal penalty. You can open a Coverdell account at a bank or any financial institution. You control the account and your child is named as the beneficiary. Some institutions may charge a fee for opening and/or maintaining a Coverdell account. You might be interested in opening a Coverdell account if you have less than $2,000 to invest in a single year. You want complete control over the investments in your account. You want the flexibility to use the money for elementary or secondary school in addition to college, and you meet the income limits. To make the full $2,000 contribution to a Coverdell account, a married couple's joint income must be less than $190,000, and an individual's income must be less than $95,000. A partial contribution is allowed for people with income slightly above these levels. Now let's talk about another college savings option that offers federal tax advantages: U.S. savings bonds. Series EE and Series I U.S. savings bonds offer a special tax benefit for college savers. The interest earned by the bonds is exempt from federal income tax if the bonds are used to pay for college expenses. But to get this tax benefit, your income must be below a certain level. For 2013, to exclude all of the bond interest, married couples must have a modified adjusted gross income of $112,050 or less at the time the bonds are redeemed, and individuals must have an income of $74,700 or less. A partial exemption of interest is allowed for people with income slightly above these levels. The interest earned on U.S. savings bonds is always exempt from state income tax, no matter what your income level, and even if the bonds aren't used to pay for college. The principal is guaranteed by the U.S. government on both types of bonds. And Series I bonds offer a measure of protection against inflation by paying you both a fixed interest rate for the life of the bond and a variable interest rate that's adjusted twice a year for inflation. You might consider buying EE and Series I bonds if you need the flexibility to use the bonds for any purpose. Remember, you only need to use them for college if you want to exempt the interest earned on the bonds from federal income tax, assuming you meet all the requirements. Series EE and Series I savings bonds are easily purchased at most banks and financial institutions or directly from the federal government. They are available in denominations ranging from $50 to $10,000. Now I'd like to talk about custodial accounts. A custodial account doesn't offer federal tax-deferred and tax-free earnings like a 529 plan or covered dole account, but it does provide some opportunity for tax savings, which we'll discuss in more detail in a moment. You may notice that the word UTMA or UGMA often precede the term custodial account. UTMA stands for Uniform Transfer to Minors Act, and UGMA stands for Uniform Gift to Minors Act. Whether your state has adopted UTMA or UGMA will determine what your custodial account is called and how it's governed. The UTMA is the more common of the two. Now, what exactly is a custodial account? A custodial account is an account set up at a bank or local financial institution and managed by you or another custodian you choose. The purpose of the account is to hold assets in your child's name without having to set up a trust. These assets can then be used to pay for college as well as other child-related expenses like private school or summer camp. You have complete control over the investments you hold in a custodial account, but gifts made to the account are irrevocable, which means that the only way to get money out is to spend it on a child-related item. And finally, your child will gain control of any assets that remain in the account when he or she turns 18 or 21, depending on whether your state has enacted the UTMA or UGMA. Let's look at the potential tax savings of a custodial account. This table shows how earnings in a custodial account are taxed. Earnings and capital gains generated by assets in the account are taxed every year to the child, and they don't grow tax deferred. But under special rules known as the kiddie tax rules, children under a certain age are taxed at their parents' tax rate. The kiddie tax applies to children under age 19 and to full-time students under age 24 who don't earn more than one-half of their support. Currently, the first $1,000 of earnings is tax exempt, the next $1,000 is taxed at the child's rate, and anything over $2,000 is taxed at the parent's rate. Bottom line, you'll have an opportunity for some savings, assuming your child is in a lower tax bracket than you, if the earnings and/or capital gains generated by the assets in the account are $2,000 or less for the year. For example, if you give stock that has appreciated in value to a custodial account and then you as custodian sell it on behalf of your child, any earnings from the sale would be taxed according to this table. The result is you may pay less tax than if you had sold the stock yourself. Finally, I want to talk briefly about mutual funds and stocks. Many parents save for college by investing in mutual funds and stocks. However, although special tax rates apply to long-term capital gains and qualifying dividends, these investments offer no tax advantages specific to education. Remember the slide we looked at earlier where we compared a taxable investment to a tax-free one? To recap, a $10,000 investment earning an average of 7% per year for 18 years would grow to $24,232 in a mutual fund taxed at 28% each year on all earnings, but to $33,799 in a tax-free 529 plan or Coverdell Education Savings Account for a difference of $9,567. So even though mutual funds and stocks offer flexibility because they can be used for non-educational purposes, the fact that they offer no tax advantages specific to education generally makes them less attractive as the main component of your long-term college savings strategy. This comparison chart shows how the college savings options we've discussed stack up against each other. As you can see from the first two rows, Coverdell accounts are the only option with an eligibility restriction on who can participate and the only option with a low contribution limit, which is currently $2,000 a year. So Coverdells are unique in this way. Moving on, which options offer you the full investment control? All of them except 529 plans. Remember, with a 529 college savings plan, you choose from the plan's pre-established investment portfolios. And with the 529 prepaid tuition plan, you just contribute money and the plan does the rest. All the options let you choose your specific investments. Now let's look at tax-free earnings, one of the more important features. 529 plans, Coverdells, and U.S. savings bonds all offer tax-free earnings if the money is used for qualified education expenses. There is an asterisk next to U.S. savings bonds because your income has to be below a certain amount for you to get this tax benefit. Next up is flexibility. That is, which option allows you to use the money you've saved for non-educational expenses without paying a penalty. 529 plans and Coverdells impose a 10% federal penalty on any earnings not used to pay qualified education expenses. Custodial accounts, while not requiring you to use the money solely for colleges, do require that you use the money for some type of child-related expense. By contrast, U.S. savings bonds, mutual funds, and stocks can be used for anything. Now let's see how the options are classified for purposes of federal financial aid. 529 plans, Coverdell accounts, U.S. savings bonds, mutual funds, and stocks are all classified as parents' assets, provided the parent is the owner of the investment of the account. Custodial accounts are classified as child assets, which you might remember from our earlier slide is less favorable because 20% of child assets are deemed available to pay college costs compared to only 5.65% of parents' assets. And finally, let's compare fees. 529 plans, Coverdells, custodial accounts, mutual funds, and stocks all have potential fees associated with them. To find the best college savings option for you, you'll need to weigh all of the factors in light of your own personal situation and preferences. Now I'd like to analyze the college saving options we've discussed against the backdrop of a hypothetical couple, Mary and Joe. Mary and Joe are 42 years old and they have two children ages 7 and 5. Their combined income is $145,000. They have just received a $16,000 inheritance which they plan to earmark for college. Plus they would like to start making regular monthly contributions to a college fund. What college savings option should Mary and Joe consider? Looking at the tax advantage options, one thing Mary and Joe could do is to contribute to a 529 plan. Let's assume they don't want to limit their children's choice of college. In this case, they could open two college savings plans accounts, one for each child. They could allocate some of their $16,000 windfall to each account, and they could also establish automatic monthly contributions to each account that would come directly from their bank account. The investment portfolios they choose for each account will depend on their risk tolerance and time horizon. And Mary and Joe will need to periodically monitor the investment performances of the portfolios they've chosen and make changes if necessary. Mary and Joe might also consider funding one or more Coverdell accounts. Their combined income of $145,000 is well below the $190,000 limit to make the full $2,000 contribution. Let's assume Mary and Joe are interested in buying some stocks that they've recently researched. Well, a Coverdell account might be a good umbrella under which to purchase them. Mary and Joe could open 2 Coverdell accounts as an additional complementary strategy to their 529 college savings plan account. And instead of making monthly contributions to the Coverdell accounts, Mary and Joe could instead contribute any unexpected money that they happen to receive, such as bonuses, tax refunds, or gifts from their children's grandparents. Unfortunately, with a combined income of $145,000, Mary and Joe don't meet the income requirements for excluding the interest on U.S. savings bonds. So there's no federal tax advantage here. So they might decide that inflation protection of Series I bonds is attractive. Even so. Mary and Joe might also want to open a custodial account, especially if they have any appreciated assets to gift to the account. But remember, any assets sold in the account would be taxed according to the table we saw earlier. And pursuant to the Kitty tax rules, any unearned income over $1,900 would be taxed to Mary and Joe at their tax rate. Now I want to shift gears for a moment and address an issue that's often come up. And that's how savings for college affects your retirement savings. It's definitely a balancing act, but ideally you should be saving for retirement at the same time you're saving for college, because there are no loans, grants, or work-study programs for retirement like there are for college. You'll miss out on years of tax-deferred growth in your retirement accounts, and it's hard to catch up later. If you absolutely can't save for both college and retirement at the same time, it's probably best to err for now on the side of saving for retirement. A financial planner can help you sort through your options. And finally, most financial professionals recommend that you dip into your retirement accounts to pay for college expenses only as a last resort. Doing so will deplete your retirement nest egg and leave less money to reap the benefit of tax deferral. As you embark on saving for your child's college education, keep in mind that a financial professional can help you by creating a college saving strategy that's right for you. By completing a dry run through the financial aid formulas, you can get an idea of how much aid your child might be eligible for. By periodically reviewing and adjusting your strategy in light of tax law and market changes to make sure it's operating at maximum efficiency, and by making sure that your retirement savings are on course as well. Whether you are starting to save for college or approaching the high school years when your child will be applying to colleges, I hope you found this presentation helpful. If you have any questions, we would be happy to answer them. If you need more information about your own personal situation and would like to meet, to have us review your information and run some calculations, you can sit down with one of our financial advisors over coffee for guidance and assistance. In a moment, I will put up our contact information, and thank you again. You've been a wonderful audience.